Welcome to The Explainer. Today, we're diving deep into some seriously brilliant insights from Market Matters Episode 6, hosted by Jolin Cassidy. We're going to figure out what actually happens after you buy a real estate property. For so many people, the whole focus is just on the acquisition, getting the keys. But today, we're shifting gears to look at the long-term stewardship of that asset. We're talking equity, leverage, and this absolutely fascinating concept called capital velocity. Okay, let's dive into this. You found the perfect property, you ran the numbers, you bought it. Most folks out there, they honestly think closing on a property is the finish line. They think, you buy a rental, collect the rent every month, pay the mortgage, and hopefully, fingers crossed, someday the property is worth a lot more. But that assumption completely misses the reality of how wealth is actually built. Buying the asset isn't the finish line at all. It is literally just the starting line. So here is our agenda for today's focused lesson. First, we'll explore why the investment truly begins after the purchase. Next, we're looking at return on current equity. Then we'll connect the dots between capital velocity and macroeconomic rates. And finally, we'll wrap up by breaking down the responsible growth playbook. Let's get right into it. Section 1, the investment begins now. We're looking under the hood of a real estate asset. Listen, a solid real estate investment isn't just about passively collecting rent and, crossing your fingers that the market goes up. It's a dynamic, multifaceted machine. When you manage it correctly, you're actively improving the economics of the asset over time. Think of it like a living, breathing financial tool that requires your active understanding and participation. Now, what's really interesting about this slide is how all these multiple engines are working at the exact same time to build your wealth. It's like a finely tuned motor. You've got cash flow, right? That's the money left over after expenses. You've got principal paydown, which basically means your tenants are indirectly paying off your debt for you. Then there's potential rent growth and property appreciation. Plus, you can actively create value by fixing up the property. And hey, don't forget inflation. I know inflation hurts at the grocery store, but it actually creates a declining real burden on long-term fixed-rate debt, making your mortgage way easier to carry in future dollars. Eventually, all of those engines working together create something incredibly important: equity. But let's be clear, equity isn't liquid cash just sitting around in your checking account. It's effectively money that's stored inside the property. Having this stored capacity provides a fantastic safety net. It protects you when property values dip, and it absolutely helps you survive the bad years. But as your equity grows, it kind of forces you to ask a brand new question about how efficient your capital really is. Which brings us to Section 2, return on current equity. We need to change the way we measure investment success. Let's walk through this hypothetical scenario just to put some real numbers to it. Imagine you bought a rental property years ago. Today, it's worth $500,000, and you only owe $150,000, leaving you with $350,000 in gross equity. Now let's say it produces $12,000 a year in positive cash flow, and your original down payment was just $50,000. If you just look at that $12,000 against your original $50,000 investment, man, it looks like an absolute home run. You'd think you're earning an incredible return, right? And this brilliantly illustrates the crucial difference between a novice and an expert. The novice is only looking at the return on original investment, but the experienced investor, they're looking at the return on current equity. You see, you don't just have $50,000 in this deal anymore. You currently have $350,000 of equity tied up or trapped in this house. You have to analyze the capital you currently have sitting inside the asset today. So when we actually do that math, $12,000 of cash flow divided by your current $350,000 in equity is only a 3.4% return. Wow. Now, that doesn't mean it's a terrible investment, and it definitely doesn't mean you should rush out and sell the property, but it absolutely prompts an experienced investor to pause, take a step back, and ask a very critical question about capital efficiency. And that question is, could a portion of this equity safely be redeployed somewhere else? This right here is the gateway to understanding capital velocity. Now, I want to be super clear. Sometimes keeping a property lightly leveraged is exactly the right move. It's safe, you sleep well at night, and it gives you total peace of mind. But if your goal is to grow a larger portfolio, you really have to ask if that trapped equity could be doing a lot more heavy lifting for you. Let's move on to Section 3, capital velocity and rates. We're going to see how the broader macroeconomic environment unlocks local markets. Think about this comparison for a second. If you just hold property A, it hums along, producing income, paying down debt, and appreciating, which is great. But if you borrow responsibly against the equity in property A, you can use that liquidity as a down payment for property B. You didn't sell property A, it is still churning away, working for you. But now you've recycled that capital to acquire a second asset, totally accelerating your wealth creation without having to painstakingly save up an entirely new down payment from scratch. Now, how do macroeconomic factors like interest rates play into all this? Well, when most people hear that interest rates might fall, they only think about cheaper mortgage payments for new buyers. But the hidden impact is massive for existing owners. When rates drop, it unlocks that trapped equity because the math on the debt service suddenly makes sense again. You can actually borrow against your asset while still maintaining an acceptable positive cash flow. Let's move to this next concept and see how this builds into an undeniable market force. We call this the interest rate chain reaction. Rates drop, affordability improves, existing equity suddenly becomes economically accessible, that capital gets redeployed, and boom, overall market demand spikes. This is a massive warning for buyers just sitting on the sidelines waiting for rates to drop. If you wait for lower rates, you are going to get hit with a tidal wave of competition from existing investors who are suddenly recycling their capital. Let's ground this concept locally. In north central Idaho, local markets like KMDI, Coolski, Stites, and Grangeville currently offer buyers some real negotiating leverage. Because rates have been higher recently, properties tend to sit just a bit longer, sellers are way more likely to consider concessions, and the overall competition is lower. So, ironically, today's higher rates actually give buyers the incredible gift of time and leverage. It's really like a teeter-totter. Higher rates create incredible acquisition opportunities and give you all the negotiating power. Lower rates, on the other hand, create refinancing and capital recycling opportunities, but they completely wipe out your negotiating power by cranking up the demand. Wise investors, they don't try to perfectly predict interest rates with a crystal ball. Instead, they just learn to recognize the specific opportunities that each unique environment provides, and they act accordingly. And that brings us to Section 4, the Responsible Growth Playbook, balancing capital velocity with a margin of safety. So the crucial point is this specific 7-step system. Buy what you can comfortably afford today. Stabilize the asset by deeply understanding the actual numbers. Build equity by letting those engines we talked about do their heavy lifting. Measure what your current equity is actually earning. Access it only if the conditions make sense. Redeploy that capital strictly if the next investment justifies the risk. And finally, repeat, but only when the numbers continue to work. This is an amazingly powerful system for capital velocity, but let me tell you, it relies on strict, unwavering discipline. Because while capital velocity is incredibly powerful, your survival must always come first. Remember, the exact same dollar isn't magically sitting in two different properties. You created a new liability to do this. Leverage accelerates wealth, yes, but it also rapidly accelerates losses if things go sideways. If a tenant moves out, if the roof suddenly caves in, or if the whole economy takes a massive downturn, you cannot, under any circumstances, put yourself in a position where you become a forced seller. To prevent that nightmare scenario, you absolutely must prioritize portfolio survivability. You have to build incredibly strong cash reserves, maintain positive cash flow, and ensure a highly reasonable loan-to-value ratio. Because the true advantage of owning a long-term asset is time. Think about it. If the market dips, but you have proper reserves and solid cash flow, you don't have to panic. You can simply wait it out. But the minute you borrow so aggressively that you have to sell to stay afloat, the market makes the decision for you. And that brings us to our final thought for this explainer. Never sacrifice survivability for velocity. The ultimate goal isn't just owning the most properties or maxing out your leverage to look good on paper. The true goal is being a wise, resilient steward of your assets so they serve you and your family's future for decades to come. So I'll leave you with this provocative question to evaluate your own portfolio today. Is your current equity working efficiently for you, or have you quietly sacrificed your safety net just to grow too fast?